War in the Middle East is sending tremors through the global economy. The escalating conflict has pushed oil prices to record highs and has placed one of the world's most critical shipping routes, the Strait of Hormuz, under strain. Yet, as we record this episode on the 17th of March, financial markets appear relatively calm, at least for now. Are investors assuming this disruption will be short-lived, and what happens if it isn't? Welcome to No Ordinary Wednesday, an Investec Focus Radio essay podcast where we examine the forces shaping markets and the global economy. I'm Jeremy Maggs. Now, energy shocks have a habit of lasting longer than expected, and when they do, the consequences ripple through inflation, growth, and investment markets. In this episode, we examine the conflict's implications for the oil market, global growth, the investment landscape, and for South Africa. Joining me are three Investec experts from London. We have Callum Macpherson, Head of Commodities, and Phil Shaw, Chief Economist, who are both from Investec UK, and Chris Holdsworth, Chief Investment Strategist at Investec in South Africa. Chris, Phil, Callum, a warm welcome to No Ordinary Wednesday. So Callum, let's start with the oil market. We've been seeing wildly fluctuating prices and even a surge above that psychologically important $100 per barrel mark. To what extent then is this price behaviour a reflection of genuine supply disruption, perhaps versus a market trying to price geopolitical uncertainty?
Well, there is genuine disruption. Something like 20% of world supply is currently unavailable because of the war that's going on, which is absolutely unprecedented, certainly for a very long time, for us to have a disruption of that magnitude. And I think even if the war were to stop tomorrow, the degree of disruption to logistics, damage to infrastructure, inventories that have been drawn down to make up for supply shortfalls mean that it would be very difficult for the market just to snap back to where it was in, say, early February. On the other hand, if the war continues for an extended period, many more weeks or possibly even months, at some point we have to face the reality that the demand for oil, the consumption of oil, is going to have to be cut back so that it's in line with actual supply. Because at some point inventories will be exhausted, then we reach a stage where there's no alternative but to cut back demand. And cutting back demand by 20% would be something like what we saw during COVID in terms of the restrictions on mobility and business activity that would be required to bring consumption of oil back into line with available supply of oil if this supply disruption continues. So I think that gives us an idea of just how serious this problem is and how much more serious it could become. And if you think about what sort of price oil would need to be at in order to disincentivize that amount of demand, it's probably very much higher than we've already seen. So we talked about 100. We did see nearly $120 per barrel briefly on Brent, but it may need to go a lot higher than that. So the market at the moment is trying to work out where on this spectrum are we going to end up. Is the war going to end relatively soon because of the pressures that it's creating, or is it going to go on for an extended period? And it's very hard, of course, for the market to know, which is why things are so volatile.
Callum, back to you in a moment, but Phil Shaw, let me turn to you. Geopolitical shocks don't always translate into economic shocks. Markets sometimes absorb them quite quickly. But looking at this conflict as it stands, Phil, what damage has already been done to the global economy?
That's true, but clearly this is a geopolitical shock that is material. We've had something like a 40% surge in oil prices in dollar terms since the attacks on Iran began, and spot natural gas prices have close to doubled. Look, it's still relatively early days, but you can see the negative impact on confidence in the economy beginning to creep in from some early surveys. And where we stand from here is that longevity of the shock is critical. So if energy prices were to remain at current levels for too much longer, it would have an impact on, for example, corporate investment decisions, and it will also hurt consumer spending. As households pay for more energy, they have less money to spend on other items. One redeeming factor, at least at the Northern Hemisphere economies, is that we're coming up to spring now. In other words, the peak expenditure period on heating is behind us. Another point is that we shouldn't just assume that this is going to be a long-standing conflict or energy price shock.
All right, Chris, let's turn to the investment landscape now. Markets have remained relatively composed so far. So why do you think the response has been restrained, all things considered? Do you think this suggests that investors may see the disruption as temporary?
Hi, Jeremy. Yeah, I think that's spot on. And we can see it in a number of different metrics. For example, if you look at the copper price, copper would typically give a good steer for what investors think about the global economy. And typically it'd be quite sensitive. And in an environment where you expect weaker growth, you would expect the copper price to come down. And it's barely moved since this conflict kicked off. And if you look at equities are down, but they're down a couple of percent. And it does seem to be the case that markets are pricing in this whole scenario, the shortages that Callum spoke about with regards to oil, to be very short-lived. And from a market perspective, that does present an asymmetry. If it is the case, in the best case scenario, this ends quite soon and we're able to rebuild the inventories and oil prices come down quite quickly, that seems to be in the price. And if it does persist a bit longer, and that's a non-negligible possibility, then it does suggest that there is some downside ahead.
So, Chris, if the conflict, though, continues into the weeks or even the months ahead, where are the first risks likely to emerge in financial markets?
We've seen some of it already. Prior to the conflict, for some central banks across the globe, there was a possibility that they were going to be cutting this year, and those possibilities were priced into the market. Think of the US as an example. The market was looking at about 2 rate cuts. If we look at South Africa, the market was looking at about 1 to 2. And already those have been ruled out. I think the next step is, as this persists, we'll start to see inflation expectations shift up. And if it shifts up sufficiently large, we'll start to see rate hikes, in fact, priced in. And then we're in a different ballpark. At that point, you then have to start to question the growth outlook for the global economy. And with that would come shifts to earnings expectations. And that, I think, would have a greater impact on markets than we've seen so far. So I think that's the sort of plan, the trajectory as it would pan out in the event that it does persist. And we need to keep a very close eye on those medium-term inflation expectations.
So, Phil, do you think markets then are underestimating the economic risks of this conflict?
I think you could argue that, at least in some markets. If you look at equities, we've had something like a 3 to 4% retracement in the S&P 500, which is basically saying no lasting damage to corporate earnings. And I'd have to reinforce that by saying that US stocks were expensive anyway. And this episode hasn't been used as an excuse for a major repricing. So arguably stock markets are quite sanguine. If you look at interest rate and bond markets, however, I'd say that they show a different picture. In the States, they are pointing to perhaps 1/4 point cut by the Fed this year. But they're expecting 1.5 interest rate increases from the ECB before the end of 2026, and roughly a 50% chance of one increase by the Bank of England as well. Now, I think we would say that this is probably pricing in too much bad news, i.e. too much high inflation.
All right, Callum, let me come back to you then. The International Energy Agency has already announced a 400 million barrel reserve release. With the conflict showing no clear end, does this meaningfully stabilize the markets, do you think, or does it simply buy time?
Well, the maths of this are relatively straightforward. So 400 million barrels, and we've got a supply disruption of, let's say, something like 20% of world supply, so around 20 million barrels per day. So this reserve release is equivalent to about 20 days worth of current disruption. And the war has been going on for something like, getting on for 20 days. So what this reserve release does is sort of replace the barrels that have so far been disrupted. Obviously it helps, it certainly helps, but it isn't a solution. And if the war continues much longer, then this will clearly not be enough. The other problem is, even if the war does end relatively quickly, is that inventory has been or will be released. And of course, once you've released that inventory, your inventories are then lower. So the ability to deal with any further disruptions, perhaps if the war started up again or whatever, or something else happens, are then reduced. And so the market needs to price for that in potentially an ongoing risk premium.
And Callum, some analysts suggest the bigger risk now is not only shipping lanes, but potential damage to Gulf oil infrastructure. How might that play out in oil markets, do you think?
It's pretty difficult to assess exactly how much damage has happened and how long it might take to repair. But I think it's worth noting that in 2019, when there was a drone strike on Saudi production processing plant, which took offline about 50% of Saudi production, it was restored pretty much to full capacity in about a couple of weeks. So it depends on the extent of the damage. Now, if something is destroyed completely, I mean, there have been suggestions concerns from the Americans in recent days that they might destroy the oil terminal on Karg Island, which is the main source of output for all of the Iranian production in terms of how it accesses world markets. Were they to do that and completely destroy it, well, that would be a serious problem. It would take a very long time to replace that. But so far, we haven't had anything on that scale. So a lot of it is precautionary, shutting things down, not necessarily that sort of scale of damage. But of course, we don't know how things might go from here.
Phil, let me bring you back into the conversation. When oil prices spike sharply, economists often ask whether it could push the global economy towards stagflation. How quickly do energy shocks like this feed into global inflation?
That's a good question. It takes time to get absorbed fully. The initial impact is on petrol prices, and many consumers in the UK are saying, well, that happens too quickly, i.e. petrol companies are profiteering. But after that, what you begin to see is a gradual pass through from, for example, manufacturing and services providers who have major energy input and whose costs have increased. The danger is that that passes through as well to higher pay settlements. In turn, that would give firms another reason for another round of price increases. And what you see is the risk permanently higher inflation. And it means that central banks have to lean against this quite hard with higher interest rates. And that's where you get a stagflationary risk, or at least you get higher inflation and a lower growth environment.
Chris Holdsworth, to you then, from a portfolio perspective, where do investors typically find resilience during energy shocks?
It's very difficult to do. Normally, in the event that there is a sizable shock, most risk assets would sell off. Even something like gold often doesn't provide protection at the start of a problem like this. The only protection you can typically get in an environment like this is cash. And the problem there is, if this does persist and it leads to higher inflation, cash is not particularly helpful. You'll lose money in real terms. So over the medium term, let's assume for the moment that it does persist and oil remains at $100 for some time. In that environment, you require hard assets. And equities actually over the long run do provide protection against inflation, but it is over the long run. So it's a question around the stage that we see. The short term, there's not much protection from anything except for cash. And over the long run, you need to be in hard assets and equities.
We'll pick up our discussion in just a moment with some scenario planning from our experts. But first, a reminder to subscribe to this podcast if you value smart, informed conversations like this one and want to get regular insights directly from the experts shaping the thinking inside Investec. Make sure you follow Investec Focus Radio SA on your podcast app or on YouTube. That way you'll be notified every time a new episode drops. So, Chris, before we get into scenarios, let's bring this home to South Africa. Firstly, then, could the war delay the country's expected economic recovery?
Absolutely, for a variety of reasons. As a start, it rules out the possibility of rate cuts. In fact, it means that we may well get rate increases in SA. In addition, it accounts for a large portion of our inputs and it may well put pressure on the rand. And in addition to that, fuel directly is about 4% of the consumer basket. So it's a tax on consumption in effect. And all those things put together means that it does dim the outlook for the SA economy.
So what could we expect to pay at the pump, do you think?
Well, that's hard to tell, but what we can say is already, given where prices are at the moment, we could probably pencil in an increase in the fuel price next month of about 4 Rand a litre. That's a pretty sizable increase, and it will have a knock on SA consumption.
Is there a potential upside here, though, Chris? Could the higher commodity prices that we've been experiencing over the past couple of months provide any offsetting benefits for South Africa?
Yeah, that's right. I mean, commodities that SA exports have done very well over the past 2 years, and they certainly are going to take the edge off this. And fortunately, South Africa exports a lot of gold. And if this does persist for a long time, as mentioned before, gold would typically do better than most commodities, even if not over the short term. So that certainly does help. But even so, we cannot escape the fact that SA is vulnerable to an energy price shock.
And the rand, Chris Holdsworth, has weakened. Does this raise inflation risks and potentially force a hike in rates?
I think the risk rather lies with energy directly. I mean, if you look a year ago, the rand was materially weaker than it is now, in large part because of the strength of commodities that we've seen. So that drew the rand stronger over the past year. And we're still in an environment where I don't think the rand by itself is adding inflationary pressure. It's more around oil in particular.
Phil and Callum, let me bring you back into the conversation. The economic consequences of this conflict will ultimately depend on how events unfold. So it may be useful to consider a few possible scenarios. So Phil, let's look at scenario one. If the conflict were to drag on for another few weeks without meaningful de-escalation, what would begin to change materially from a macroeconomic perspective?
If we're talking about the conflict lasting a number of weeks, that's probably a relatively benign outturn. Now, it might take time for oil supply to get back fully on stream, and we may not see $65, $70 a barrel oil prices for a while longer. But under those circumstances, it's still reasonable to expect a visible decline in prices. So what you then see is inflation rising for a while, but then it comes down as oil prices ease back as well. And perhaps what you get as a response from various central banks is that they hold off from cutting rates for a while longer, but those easings in policy do take place later on in the year. And what you don't get is a series of rate increases to stave off a more permanent inflation threat.
And then, Phil, if the conflict were to drag on for several months rather than weeks, how would the macroeconomic picture begin to shift? At what point do temporary shocks start becoming structural risks for the global economy?
It's difficult to put a precise timescale on it, but if we're talking about a number of months, then yes, those risks would be very much present, i.e. permanently ingrained inflation. And that's the point at which the central banks get more serious about hiking, because they become more concerned about the inflationary threat than the downside risks to the economy. The Fed might be an exception here because it has a dual mandate. It's not only got a price objective, it's got a full employment objective as well. So you could argue that the Fed, if it were to come to certain interests, certain central banks raising rates, that the Fed would be more dovish, if you like. We would note, though, that the Reserve Bank of Australia cited higher energy prices as a reason, not the only reason, but one of the reasons for raising rates earlier this week.
Chris, back to you, and let's stay with scenario 2. As you mentioned earlier, markets currently seem to be assuming this oil shock will be relatively short-lived. But if that assumption proves wrong, where would investors feel the pressure first? Would it be currencies, inflation, or equity markets?
Typically, equity markets would move ahead of any sizable shock to growth. Normally, equity markets bottom about 6 months ahead of a recession turning, as an example. So we would expect equity markets to reflect concern quite rapidly, and that's why it's so surprising that they haven't moved by much so far. And with that, there would be some move in currencies, but it's difficult to say at this point, because over the past 20 years or so, the dollar has been a very effective safe haven currency. And post-Liberation Day, it hasn't quite acted in the same way. So it's not immediately clear that the dollar would strengthen materially as a result of this conflict lasting a bit longer than expected. And inflation is typically a lagged indicator. It takes some time for those numbers to come through, but they are very meaningful. And if the inflation trajectory shifts and we land up with much higher numbers, that itself would reinforce the moves that we're going to see in currencies and equity markets.
Chris, if Trump were to pull the US out of the war tomorrow, sooner rather than later, what will the impact on the US economy be?
Well, as Callum mentioned earlier, I think there is still going to be a bit of time before we get back to normality. We've got to rebuild inventories as it is. There's a price shock, and that will take some time to correct. So it still is likely to reduce US growth relative to what were pretty buoyant expectations, say, from February. So I still see that there's some downside there, but it's not just the US. I mean, if you think of SA as an example of an emerging market, if oil is at $125 at the end of June, our estimates suggest that inflation in SA would be 7%. And it's hard to see how the SARB doesn't hike in that environment. And that sort of story is going to pan out across emerging markets, going to pan out in the US too, and it does pose some risk.
And Callum, if the conflict were to continue and significantly damage oil production or export infrastructure right across the Gulf region, how disruptive could that be for global supply?
Well, unfortunately, I think that's where we get into that worst case scenario I talked about right at the start, where inventories run down and the market has to reach a level that disincentivizes a sufficient amount of demand in order to bring the market into a balance. How high might that be? Well, Brent traded at around $100 per barrel for several years between about 2011 and 2014, and yet demand grew over that period. And of course, if you inflation adjusted, you come up to a level much higher than 100 now. The all-time high in Brent was just under $150 per barrel, set just before the financial crisis. So I would think that the level at which nobody really knows, but the level at which oil would need to get to disincentivize that sort of degree of demand is going to be probably $150 per barrel plus. So I think it's quite clear we haven't seen the worst of it if that were to become the case.
We're coming to the end of the conversation. Before we finish, let me ask each of you, what is the one indicator that you'll be watching most closely in the days, the weeks ahead? Chris, let's start with you.
Yeah, there's two. The first is the number of ships passing through the Strait of Hormuz. We track that on a daily basis. But for us, we're investors, and we're looking out for the equity market. I mean, we have been defensively positioned up until now, and we're hoping that we're going to see an opportunity in the next, call it a month or 2 months, to increase our allocations to risk assets. We're expecting that there will be some form of a pullback, and in the event that occurs, and we think that the long-term outlook is sufficiently stable and unchanged, we'll use as an opportunity to buy some assets. The problem is I think everybody's got the same view, and that's why the market hasn't moved by much. Everyone thinks this is going to be temporary, and that means that if it looks like it's going to be a bit longer, I think we will see an outsized move in markets.
And Callum?
I would say measures other than the Brent front contract. So things like the price of jet fuel has been particularly severely affected. We've seen prices of equivalent of something like $200 per barrel in jet fuel. The market very sensitive to developments, and this is what end consumers are actually paying for. People don't put Brent front contract futures into their tanks. And also the physical price of oil. So if you look at the physical market for oil going from the Middle East to Asia, for example, that's already at $150 per barrel.
And Phil, I will give the last word to you. What will you be keeping your eye on?
Well, obviously, we watch a very broad suite of indicators to tell us what's going on in the world economy. It would be tempting to say, we're watching the oil price, which of course we will be. But for something slightly different, what I'd say that I'd be keeping an eye on is President Trump's approval ratings, because he is very much politically constrained as to what he can do and how long he can do it for, because he's got the midterm elections coming up in November, and a big slide in his approval ratings would put pressure on him to simply declare victory in Iran and give up the conflict. Now, from what we can see at the moment, his approval ratings haven't actually gone down a lot, but they do stand low at -15. And if we were to see public opinion in general turning against him on this subject, then that's possibly the point where you begin to see the US think about planning a cessation to the war, and therefore perhaps that those oil prices come down and you begin to see the inflationary threat ease back a bit.
And that's where we're going to leave it. Phil, Callum, Chris, thank you for joining me on No Ordinary Wednesday. To ensure that you don't miss a show, follow Investec Focus Radio SA wherever you get your podcasts. And if you like the channel, please take a moment to rate it, as this will help us reach more listeners. Until next time, goodbye from me, Jeremy Maggs, and the entire Focus Radio team.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of the firm and should not be taken as advice or recommendations. Investec Limited and subsidiaries, authorized financial service providers, registered credit providers, and long-term insurer.